So it's not often that we're going to get a week that's got this many significant items and on multiple fronts with data in terms of earnings, as well as when it comes to central bank decisions. As a result, we're going to go ahead and dive straight into the week ahead. Hello, everyone. Monty here, market analyst at IG UAE. We're going to skip recent events, and we're just going to start off with what's on offer in terms of data. Out of the U.S., you got consumer confidence, both out of Conference Board tomorrow, as well as out of University of Michigan on Friday. And it's been a story of improving figures as long as they can continue to paint a decent enough picture there in terms of consumption. It's been a bit of a struggle, and it's expected to be a bit more tested in the next phase. So durables, personal spending, those two are going to be released this week. And in terms of growth, we got the advanced GDP for second quarter expected to show decent enough growth, 1.6, 1.7%. Atlanta Fed's GDP now figure, by the way, much healthier. Let's see if whether or not the final figure can actually match that. And then if there's in terms of housing, we got ourselves pricing data tomorrow, where it's been a story of month-on-month gains, year-on-year, a little bit of a pullback. We got new home sales where existing home sales have been suffering because a lot of those with mortgages locked at lower rates don't want to let go. So that's kind of been helping new home sales a little bit, but we're seeing existing home sales figures suffer a little bit. We got the weekly mortgage applications on Wednesday, and then we've got pending home sales. And then in terms of pricing data, this is going to be on Friday, where PCE core expected to show month-on-month growth 0.2 and year-on-year to fall back to a decent enough, still above the Fed's target, of course, but decent enough 4.2% level. And then when it comes to inflation expectation, consumer inflation expectations out of U of M, very important that they don't rise back up, that they manage to stay at these levels, if not show a significant pullback. So that's when it comes to economic data out of the U.S. We do have, preliminary PMIs on offer today, but usually when it comes to the U.S., focus is more on the final readings that come out of ISM and not the preliminary readings out of S&P Global, though that's not the case when it comes to the Eurozone and the UK, which we'll get to. When it comes to earnings, we got ourselves a whole lot more on offer this week. It's going to be a significant, and they represent a significant weighting in terms of market cap when it comes to the key indices that we're following. I mentioned that because I'm just going to go ahead and pull up IG's trading platform, US Tech 100 or Nasdaq 100. Not the best week, though, looking at it from a weekly time frame, still managing to hold, relatively speaking. Its technical overview is still relatively bullish. On the daily time frame, a bit more tested just because we're looking at it on the weekly, which factors in a whole lot more historical bullish bias, especially from the start of this year. But the pullback late last week on Thursday, that's because of what we got on Wednesday in terms of the earnings releases from both Tesla as well as Netflix. They represent about 5% of the Nasdaq 100, about 2.5% of the S&P 500. So when we go ahead and take a look at the weightings of what's on offer, with Tuesday we got Microsoft and Alphabet. One of them, Microsoft alone, as well as Alphabet, if you include both of them, represent a bigger share than those two. But then you also got Meta on Wednesday as well, and not to mention all the other companies that are going to be releasing this week. So you can expect it to be a whole lot more impacting when it comes to the key indices that we follow, as well as the share prices of those tech stocks that are quite popular on our end, both for traders as well as for investors. There's also the Nasdaq 100's special rebalance today. No changes in terms of companies exiting or entering, but it is a matter of those magnificent seven getting a hit in terms of their weightings and their concentration being reduced to the Nasdaq 100. When the news first hit, it was a Friday night. The next day, the next trading session, which was Monday, we did see that a lot of these heavyweights, the share price dropped by about 1%. So the expectation is that, okay, some of it might already be priced in, especially because when it comes to the Nasdaq 100, you got roughly estimated $300 billion that's tracking it, compared to, say, the S&P 500, where above $15 trillion estimated. So usually when you got news when it comes to the S&P 500, you can expect a much bigger move. That's why Tesla's inclusion into it a few years back, when the news first hit the wires, you saw a massive move in one session, and then you got all these big flows going in anticipating, because they knew that those that are tracking it are going to have to buy it at whatever price it might be by the time it's included in the S&P 500. So that's the data, that's earnings out of the way. Let's go ahead and get started with three central bank decisions. The Fed's going to be on Wednesday, European central banks on Thursday, and then for those of you trading the yen, the Bank of Japan is going to be on Friday. When it comes to the Federal Open Market Committee, the expectation is rate hike pretty much fully priced in. It's almost there. It's like 96%. It's usually oscillating around that level. Market pricing, by the way, courtesy of Refinitiv, but a 25 basis point rate hike. Now, there isn't much between now and then. I mentioned there's preliminary PMIs on offer today. I expect it to influence the decision, even if it was worse than expected. So there's nothing really, unless there's some significant shock outside what we're getting on the economic calendar. You can pretty much expect that we're going to go ahead and see that rate hike out of the Fed. PC is going to come on Friday, and there's going to be a whole lot of data between then and the next Fed meeting, so you can pretty much brush that aside to some extent. And of course, markets are hoping that they're pricing and hoping that this is going to be the last hike. There is a minority, and it's pretty much been a story of a minority, but a somewhat significant one at times. It did reach 40%, but generally speaking, about 20 to 30% minority on a rate hike, whether September or the November meets. And in general, in terms of market pricing, they're not pricing any rate cuts until around the first quarter of next year. At times, it has pushed out into early of the second quarter, and that's kind of in line with what the Fed wants. I've mentioned before in some of these videos that the Fed, they kept pushing back against markets pricing in any rate cuts. The Fed does anticipate, based on their dot plot, that there are going to be two hikes. So one is anticipated, they're going to announce it on Wednesday, but then they're expecting one more this year. And I do think that in terms of the Fed, I don't think it's that important for them to try and push markets into pricing one more. I do think, though, it is important for them to keep that potential hike after this week's hike, to keep one more hike open. Just keep the door open around 20 or 30%, so that if something happens, data worsens, whatever, it won't be a big shock to see markets start to price in or get close to a coin toss on whether or not we get another rate hike out of the U.S. Federal Reserve. And of course, we got ourselves 2 months until the next meeting. So once they announce, you got roughly a couple months. And that means there's going to be a lot to process between then and September. So that's when it comes to the Fed in terms of what the expectations are there. European Central Bank, again, pricing courtesy of the Fed, is pretty much fully priced in 25 basis point rate hike to take the deposit rate to 3.75%. But everyone seems to want to know what's going to happen in their September meeting. Are we looking at another 25 basis point increase? Market pricing, by a majority, saying that there is going to be another hike. That'll be the peak. That'll take it to 4% deposit rate. But here's the thing. They're in a data-dependent phase, so a lot can change in terms of market pricing, and we have seen market pricing change quite significantly between, from meeting what gets released during that period, and that means that you can expect, of course, that during the press conference, ECB's Lagarde, she's definitely going to be asked about, how hawkish is she going to be, and that, of course, is going to influence market pricing for September. But we do have, again, we have the preliminary PMIs today, and we also have, the ECB's bank lending survey going to be released prior to the ECB policy announcement on Thursday. That's when it comes to the European Central Bank. And finally, we get ourselves the Bank of Japan. No changes expected when it comes to their key rate, still negative 0.1%. And of course, when it comes to the yield curve control, expected to remain in place as is. There were moments where the Japanese 10-year yield got close, government got close to the 50 BP upper band. There were moments where it got close, but that was before CPI figures got released last Friday. And those figures, of course, because the headline was, these are figures for June, because it was lighter than anticipated, 3.3% instead of 3.5%, core and core, they were as expected, but pulling back when it comes to, when you remove food and energy, with the core, when it comes to Japan, to 4.2%. We are going to get Tokyo's pricing data for July. So Tokyo's always comes, they look at Tokyo's first, and that's always going to come first when it comes to looking at for the month of July. That's going to be released on Friday before the BoJ's announcement. Not expected to cause any changes, depending, of course, on what gets released, but we are looking forward to what the pricing projections are because the pricing forecasts from the Bank of Japan are expected on Friday. And that's going to be significant, and you can expect quite a few to come out and say, their anticipation of when they expect an eventual tweak in the yield curve control, you can expect them to come out and start talking accordingly. Going into the event, by the way, it's been a story of pretty much majority buy bias for the euro and the pound when it comes to COT speculators. They've upped that bias in the euro to 76%, not far off extreme buy territory. Pound pulling back from 68 to 65%. Yen, extreme sell, but pulling back from 83 to 80. And when it comes to Swiss francs, still heavy sell territory. So too when it comes to the Australian dollar. They didn't quite get that right when we got those bullish moves when it comes to the Australian dollar. They managed to stick with the majority sell bias throughout this period. And when it comes to the Canadian dollar, in the middle. So that's about it from Aaron. Quite a bit packed into this video. I want to thank you guys so much for watching, and happy ticks.